Every country you can point to on a map is drowning in numbers. The United States carries around tens of trillions in public debt. Japan, buried under its own mountain. Europe, the same story, different currency. Add it all together, and global debt towers at more than 3 times the size of the world's yearly economic output. But that's not the part you should fear. The real horror is the paradox underneath. If everybody owes money, who exactly is it owed to? When you trace the IOUs, from governments to banks, from banks to funds, from funds to pensions and back to governments, you discover something unsettling. The world doesn't owe money to some clear outside villain. The world owes money to itself. Yet somehow, interest still flows upward, year after year, crisis after crisis. That didn't happen by accident. Across 3 centuries, 4 men, 4 architects of modern finance, quietly designed a system where debt is never meant to be fully repaid. Governments borrow forever. Money itself is built on promises that can't be redeemed, and the people closest to the machinery collect rent on every turn of the wheel. No tinfoil, no secret cult, just charters, contracts, and institutions you can look up in public records. They solved real problems for their eras: war finance, market panics, inflation. But in doing so, they locked the rest of us into a structure where escape equals collapse. To understand how we ended up here, you have to meet the first architect. Before 1694, kings borrowed like gamblers on a bad streak. They went to merchants, nobles, moneylenders. They promised repayment with interest. If things went badly, a lost war, a bad harvest, a palace that cost too much, they defaulted. Creditors were ruined. Kings were embarrassed. Sometimes a debt was honored, sometimes it was forgotten, sometimes the creditor lost his head. It was chaotic, but it had one crucial property. Debt was temporary. Either it got repaid or it blew up and the slate was brutally wiped clean. Then came William Paterson. A Scottish trader and relentless financial schemer, he had failed at more than one grand plan. But in the early 1690s, he saw a different kind of opportunity. England was locked in a grinding war with France. King William III needed money, not tomorrow, yesterday. The treasury was empty. Tax revenues couldn't keep up with war costs. Traditional lenders were wary because England had already defaulted in the past. Paterson walked into this crisis with a proposal that would quietly alter the trajectory of the modern world. He offered to assemble a syndicate of wealthy merchants to lend the crown £1.2 million, a massive sum at the time. But here was the twist. The principal would never be repaid. Instead, the government would pay interest year after year forever. In exchange, Paterson proposed the creation of a new institution to manage the arrangement, the Bank of England. The mechanics were elegant and dangerous. Merchants would deposit their gold with the new bank. The bank would lend that gold to the government. Parliament would pledge tax revenues to pay 8% interest annually on the loan. The merchants would receive banknotes, claims on the bank that could be traded like money. The government got its war chest, the merchants got a permanent income stream, and the principal, the original £1.2 million, sat there like a sacred stone, never meant to be touched. From the government's perspective, this was a miracle. Instead of scrambling to repay, it could simply service the debt indefinitely, as long as it could tax its citizens. From the merchant's perspective, it was even better. They weren't just lenders anymore. They now owned something closer to a state-backed annuity. £1.2 million lent, 8% interest, £96,000 a year, as long as the English state existed. If a lender wanted out, they didn't have to beg the king for gold. They could simply sell their claim, their banknotes or bonds, to someone else. The debt had become transferable, liquid, tradable, and most importantly, permanent. But Paterson's real genius and the seed of our modern debt trap lay in the next step. The Bank of England was given a new power. It could issue paper banknotes backed not just by gold, but by the government's debt itself. The government's IOU became an asset. That asset became money. The more the government borrowed, the more backing the bank had to issue notes. The more notes in circulation, the more the economy depended on this type of debt-based money. This was the template. Government borrows. It never repays the principal. It services interest using tax revenue. The debt itself, those IOUs, becomes the bedrock of the monetary system. If you're a taxpayer, you just became an income stream. If you're a banker, you just acquired a machine that can run for centuries. Within a few decades, other European powers copied the model. France, the Dutch Republic, later the newly independent United States, all embraced some version of permanent public debt, traded as bonds, underwritten by future taxes. William Paterson died in 1919, without the dynastic fortune you might expect from someone who rewired global finance. But the institution he conceived, the permanent national debt administered by a central bank, outlived him by more than 3 centuries. British government debt was never taken down to zero. It was rolled over, refinanced, expanded, repackaged, but not extinguished. A pattern had been set. Debt was no longer a temporary bridge between scarce moments. Debt became the foundation. And Paterson was only the first architect.
By the early 1800s, European governments had learned to live on debt the way a city learns to live on a river. They floated bonds to fund wars, ports, canals, and day-to-day expenses. But there was still something primitive about the system. Each major loan was a one-off negotiation. One country, one group of creditors, one set of terms. Interest rates varied wildly. Access was limited to a narrow circle of very rich merchants and houses. Default, while damaging, still happened and remained localized. Enter the second architect, Nathan Rothschild. The Rothschilds began as modest money changers in Frankfurt. By 1800, the 5 brothers had spread out to London, Paris, Frankfurt, Vienna, Naples, forming a web of family banks across Europe. Nathan, based in London, became the strategic center of that web. The Napoleonic Wars created an enormous demand for funding. Armies had to move, ships had to sail, supplies had to be bought, all before tax revenues arrived. Nathan's innovation wasn't just lending to governments. It was industrializing sovereign debt. Instead of making a direct, illiquid loan to a state, he bought large blocks of government bonds at a discount, used his family's trans-European network to resell them to investors, pension funds, wealthy individuals, institutions, at a markup, maintained an active secondary market where those bonds could be traded. Government got something it desperately wanted: speed and scale. It could raise huge sums quickly. Rothschild got what he wanted: the spread, and more importantly, control of the pipeline between governments and investors. For investors, the bonds became a new kind of asset: tradable, liquid, interest-bearing, relatively safe. But the really transformative part lay in the interconnection this new system created. A British bond might be bought in London, resold in Paris, pledged as collateral in Vienna, and used to back another loan in Naples. Debt was no longer a simple line between one sovereign and one lender. It was becoming a network. The famous story from 1815, at the end of the Napoleonic Wars, captures how potent that network could be. According to many accounts, Nathan Rothschild received news of Napoleon's defeat at Waterloo before the British government did, thanks to his private courier system. Armed with that information, he is said to have moved in the bond market, selling British bonds first, signaling panic, pushing prices down, then quietly buying enormous quantities after the crash. When official news of victory arrived and confidence returned, bond prices surged. Whatever the exact details, the broader reality is clear. Rothschild's edge was information and speed. He could sense the direction of history before the public did and position himself in the flow of both war and peace. By the 1820s, the Rothschild houses had become the dominant force in European sovereign debt. If a government wanted to borrow on favorable terms, it went through them. They had the distribution network. They had the trust of investors. They had the leverage to set conditions. And that's where the trap deepened. Before this web existed, a king who defaulted was a disaster for his creditors. But the damage was relatively contained. After Rothschild, default became a systemic weapon. Government bonds were held across borders, woven into the balance sheets of countless banks and families. If a major state refused to pay, it wouldn't just hurt its lenders. It would rip through the entire financial fabric of Europe. Banks' balance sheets would crater, collateral would vanish, credit lines would freeze. Other governments would be destabilized. Default, in other words, didn't just mean we won't pay. It meant we might collapse your entire financial system. And once default becomes system-threatening, it also becomes politically unacceptable. You don't dare pull the plug, even if the numbers say the patient's already gone. That was the Rothschild revolution. Paterson had made government debt permanent. Rothschild made it too interconnected to fail. Governments discovered they couldn't simply walk away from their obligations, no matter how large or politically unpopular those obligations became. They had to keep paying. And when they couldn't, they had to borrow more to cover the interest on what they already owed. A spiral had started. The Rothschild fortune peaked in the mid-19th century. For a time, they were reputed to be richer than kings, and unlike kings, their wealth wasn't tied to land or armies. It was tied to interest on sovereign debt. They didn't build canals. They didn't invent new machines. They stood at the intersection of states and markets and took a cut every time one borrowed from the other. The Paterson model had given birth to permanent debt. The Rothschild model had turned that debt into a global, tradable, inescapable web. By 1900, one more ingredient was needed to turn the system into what we know today. A way to create money itself out of government debt on a truly industrial scale. That task would fall to a man in America.
By the turn of the 20th century, the center of gravity was shifting. Europe had been the workshop and battlefield of the debt system. Now the United States was rising, vast, industrial, resource-rich. But America's financial structure was messy. Thousands of banks operated on their own. The money supply was tied to gold and fragmented between regions. There was no single institution to act as a lender of last resort. When panics hit, and they did, repeatedly, everything seized up. Then came the panic of 1907. A speculative bubble burst. Stock prices crashed. Banks failed. Trust evaporated almost overnight. Into that chaos stepped one man, J.P. Morgan. Not a government official, not a central banker, a private financier, but one whose balance sheet was as formidable as many nations. Morgan summoned the heads of the major New York banks to his library. He locked the doors and made it brutally simple. Either they collectively put up funds to save key institutions, or they all went down together. They complied. The panic was contained. The economy stabilized. For a brief moment, one banker had functioned as the central nervous system of American finance. But Morgan was old. He couldn't play that role forever. And everyone understood that the next crisis might be bigger than any one man's fortune. So the conversation shifted from who saved us to what permanent structure do we need? The answer, a central bank. But that phrase was politically toxic in America. Twice before, attempts to create central banks had been beaten back by populist anger. Americans associated central banking with aristocratic control and foreign influence. So, the third architect had to hide his design in plain sight.
In 1910, under the cover of secrecy, a small group of men boarded a private train in New Jersey. Among them, Senator Nelson Aldrich, deeply connected to Wall Street. Senior partners from major banking houses, including interests aligned with Morgan. They traveled to Jekyll Island, a private resort off the coast of Georgia. For about a week, they worked behind closed doors, drafting what would later become the blueprint for the Federal Reserve System. They avoided the word central bank. They avoided any suggestion that Wall Street would control it. Instead, the plan they forged was a masterclass in political camouflage. It wouldn't be a single monolithic bank. It would be a Federal Reserve System with 12 regional reserve banks. It wouldn't be explicitly private. There would be a board of governors appointed by the president. It would sound federal, distributed, and public-minded. But embedded in the structure was the reality. The regional Fed banks would be owned by commercial member banks. Those banks would elect key decision-makers at the regional level. The most powerful reserve bank, the one in New York, at the heart of Wall Street, would carry the heaviest operational weight, particularly in buying and selling government bonds. In 1913, Congress passed the Federal Reserve Act. Most legislators did not fully grasp what they were creating. Voters had little idea that a new institution had just been given the most potent tool in modern finance: the power to create money by purchasing government debt. Here's how the mechanism changed everything. The U.S. Treasury issues a bond, an IOU promising future payment plus interest. The Federal Reserve buys that bond, not with gold, not with accumulated savings, but with newly created reserves, digits conjured into existence. The government now has spendable money. The bond sits on the Fed's balance sheet, earning interest. Before this, there was a natural limit. Banks could only lend as far as their reserves and deposits allowed. Government borrowing, while expandable, was still constrained. After the Fed, that constraint melted. There was now always a big buyer in the room. If private demand for government bonds weakened, the Federal Reserve could step in, purchasing debt with freshly created money. This is what turned the Paterson-Rothschild structure into something closer to infinity. Paterson had made debt permanent. Rothschild had made it interconnected and global. Morgan's world produced a central bank that could expand the money supply by absorbing as much government debt as needed. Without the Fed, a debt level like today's U.S. total would be unimaginable. Markets would have balked decades ago. Interest rates would have spiked. Politicians would have been forced into brutal austerity or outright default. With the Fed, the U.S. government can roll over old debt, issue new debt, rely on the Fed to backstop demand whenever the market gets shaky. And the interest? It still flows, from taxpayers to bondholders, from real production to financial claims. By the 1970s, this three-layered architecture was fully global. Most advanced economies had central banks, deep sovereign bond markets, and permanent public debt as a feature, not a bug. But there was one more problem to solve. What happens when poorer countries can't keep up? When they borrow in this system, and then the bill comes due? That is where the fourth architect enters the story.
By the late 1970s, the machine was humming. Governments borrowed. Central banks managed crises with interest rates and money creation. Global investors treated sovereign bonds as the spine of their portfolios. But beneath that polished surface, a new pressure point was forming. Developing nations, from Latin America to Africa to parts of Asia, had been encouraged to borrow heavily in the 1960s and 70s. They issued dollar-denominated debt to fund highways, dams, industrial projects, and basic state functions. Rates were relatively low. Dollars were abundant. Growth projections were optimistic. Then, inflation in the developed world began to rage. In the United States, prices were rising at double-digit rates. Confidence in the dollar wobbled.
Foreign governments started to doubt whether America could control its own currency. Enter the fourth architect, Paul Volcker, chairman of the Federal Reserve from 1979 to 1987. Volcker's job was simple in description, brutal in execution. Kill inflation. Restore faith in the dollar, no matter the cost. So he did the one thing almost no politician would dare to do. He pushed interest rates into the stratosphere. The federal funds rate, the core short-term rate the Fed controls, was driven up to levels around 20%. It was a financial sledgehammer. In the U.S., it triggered a deep recession. Unemployment spiked. Loans became painfully expensive. Businesses and households suffered. But abroad, the shock was even worse. Countries like Mexico, Brazil, Argentina, and others had borrowed billions in dollars at much lower rates. When Volcker slammed rates higher, their debt burdens exploded. Mexico owed tens of billions. Brazil, Argentina, and others faced similar mountains. Suddenly, just the interest on their loans consumed their export earnings. In August 1982, Mexico did what the numbers demanded. It announced it could not meet its obligations. Technically, that was a default. In a clean system, the next steps would be obvious. Creditors would take losses. Bad debts would be written down. The system would reset around reality. But remember the world we're actually in. Banks in the U.S. and Europe held huge amounts of this developing world debt. If Mexico and its peers formally defaulted, major Western banks would become insolvent. The crisis would boomerang back into the heart of the system. Volcker, sitting atop the Federal Reserve, now faced a choice: allow the correction and risk cascading bank failures, or protect the system even if that meant trapping entire nations in debt for generations. He chose to protect the system. The tool he used was not the Fed alone, but a global institution, the International Monetary Fund, IMF. Here's how the Volcker-era solution worked. The IMF stepped in to lend money to crisis-hit countries like Mexico, Brazil, and Argentina. Those new loans were used not to rebuild their economies, but to keep making payments to Western banks on the old debt. In exchange, debtor countries had to accept structural adjustment programs, a polite term for harsh conditions. Those conditions included cutting government spending, often on social services, wages, and subsidies; privatizing state-owned enterprises, often sold cheaply to foreign investors; opening markets to foreign capital and imports; devaluing their currencies, making imports expensive and exports cheap. On paper, this was about stabilization and reform. In practice, it did something else. It locked these countries into permanent debt service. The principal rarely shrank. It was rolled over, restructured, renamed. But it stayed. Interest payments flowed, year after year, from struggling economies to large creditor institutions. This was the Volcker innovation. When debt becomes unpayable, do not allow a clean default. Instead, inject new loans. Demand policy changes. Keep the old creditors whole. Stretch the timeline so the burden shifts from one generation to the next. The debt trap was no longer just permanent and interconnected. It was now inescapable, even in a crisis. From the 1980s onward, variations of this pattern played out again and again. Latin America in the 80s, Asia in the late 90s, Eastern Europe, Greece, and others in the 2000s and 2010s. Smaller states repeatedly in the 21st century. Every time, the same choreography. Debt explodes. The system faces potential collapse. International institutions step in with rescue packages. Austerity is imposed. Assets are sold. Sovereignty is quietly traded for stability. The debt itself remains. Now stack the four designs on top of one another. Paterson, 1694. Debt becomes permanent and tied to state power. Rothschild, early 1800s. Debt becomes tradable and globally interconnected, making default unthinkable. Morgan and Jekyll Island, 1913. Central banks gain the power to create money and absorb debt, making borrowing effectively limitless. Volcker and the IMF model, 1980s onward. When debt is unpayable, it is restructured, not forgiven, making debt peonage global and enduring. That is how we arrive at the world you live in. Over 300 trillion in global debt. Governments, companies, households, all chained to interest payments. Central banks sitting at the center, expanding and contracting the flow of money based on the needs of the system, not necessarily the needs of citizens. So who is all this debt owed to? Here is the uncomfortable answer. Mostly to ourselves, but not equally. Take the United States as an example. Trillions of treasury bonds are held by pensions, mutual funds, insurance companies, commercial banks, and the Federal Reserve. Those bonds pay hundreds of billions of interest every year. Where does that interest come from? From taxes, from the work of millions of people who will never see their names on a bond certificate. Money flows from workers and consumers through the state to the holders of financial assets, the institutions and individuals who own the bonds, the funds, the banks. Globally, the pattern is similar. Nations owe money to their own financial systems. Those systems are cross-tied to one another. Everyone's liabilities is someone else's asset. If all governments tried to pay off all their debt, the result would be catastrophic. The money created by that debt would vanish as bonds were retired. The global money supply would shrink violently. Deflation and depression would tear through economies. So the system chooses the only path it allows itself to go to. Roll the debt, refinance it, let it grow, service the interest, repeat. In this world, debt is no longer a problem to solve. It is the operating system itself. And the rent we pay as taxpayers, as borrowers, as consumers, is the interest that climbs, quietly, to the top of the pyramid. The four architects never sat in a room together. They didn't sign a shared manifesto. Each faced a crisis of their time and solved it in a way that preserved state power, protected major creditors, and deepened the role of debt in the fabric of the economy. Centuries later, their solutions have fused into one machine. You live inside it. If this changed how you saw those big numbers scrolling past on news tickers, if 38 trillion no longer feels like a mistake, but like the inevitable outcome of a design, then you're beginning to glimpse how power really works. You were taught that debt is a problem we'll eventually fix. The architects understood something different. Debt is the foundation, and interest is the rent we all pay for the privilege of living inside their system.